Thanks for tuning into Talking Point. I'm your host, Neeraj Shah. The talking points for why the markets are going through a jittery phase are many. On the global front, you could argue that the latest first round of conversations between US and China have not started off on the best of notes. We have rising yields and rising cases across the world, because of which there have been lockdowns. As we hear, Paris is going into lockdown starting Friday midnight. In India, back home, the cases are rising. Crude, which has fallen big time yesterday, but otherwise has had a bit of a rising trend too. And of course, the primary market issuances are up and alive, which might be pulling away liquidity from the secondary market. So multiple ways to look at the current markets. But the point being, what should an investor think, or how should an investor think about the investment approach in the current times, keeping in mind what's happened over the last 6 to 12 months as well? Well, we get in a very special guest today to talk about that, and to talk about how he is steering the investments at the PMS and the AIF products at ICICI Prudential. The head of the PMS and the AIF products at ICICI Prudential, Anand Shah, Johnson, right now on Talking Point. Anand, good having you. Thanks so much for joining in. Hope all is safe. Oops. I can't hear you, Anand. Are you on mute by any chance? No, somehow I'm not able to hear you. I don't know if it's only me. I'm going to request my team to tell me if it's only me who can't hear you, or is it something else. But somehow your voice doesn't seem to be coming through, and it was coming through a minute ago when we were doing the checks. Anand, somehow we can't hear you. Is there a volume toggle out there that you can help us with, so it's that we can get this going straight? No, somehow we can't hear you. Okay, I'll just request my team to try and just get this sorted. In the meanwhile, viewers, I just want to fill you in with a couple of data points, if you will, that we might want to just get in the back of our mind before we get started with the show per se. Right? We'll just wait for Anand to come in. Sometimes these things can happen. So 2 or 3 things, and I was trying to surmise this in my trade setup this morning as well, that if you look at the obvious pain points in the last few sessions, and especially in the last 24 hours, there are 3 or 4. One, that the number of cases across the world are rising. And as I said, Paris is going into lockdown. And Maharashtra recorded the highest spike in the number of COVID cases since coronavirus broke out. And that's the key. That's the larger point. That it's not just in the last 1 month, 2 months, 3 months. It's since COVID broke out, Maharashtra has reported the highest daily spike with 25,000 cases. The US 10-year Treasury yield jumped about 11 basis points and went above the intraday level of 1.75%, which is the highest since January 2020. That's the third key point. And the first high-level gathering of the US and Chinese officials under President Joe Biden kicked off with an exchange of insults at the pre-meeting press event on Thursday. This is as per NBC News. I haven't independently verified, but I would presume that NBC News would give out the right data. So there are pain points. In addition to that, as I was talking about, that the IPO calendar is just so strong currently, and might be one reason why money is getting pulled over as well. Well, let's pose those questions to Anand now. I think I probably will be able to hear him now. Anand, can you give me a count?
Yeah, can you hear me?
I can hear you now. Good morning. Okay. Hope all is safe, Anand.
Sorry,
okay.
I didn't get you.
No, I was just asking you if all is safe. Hopefully, all is safe. Just tell us, Anand, how are you looking at the current scenario in light of the fact that we were on the road to recovery, or we are probably still on the road to recovery on the economic front, on the earnings front, and then we've been gripped by a couple of events that have materialized out of nowhere, one being a bit of a third wave, and the fact that it's not just global but in India as well, and yields have suddenly shot up despite the Fed reassurances.
I think this case being sort of coming back in second wave and third wave was very much expected. It's just that when things are very good, you don't expect that to come back. But given that the vaccination is not through, this is very much in line with the expectations. And contrary to that, and that's the fear that the economic recovery might not come back, if the inflation is going up, the commodity prices look strong, is telling you that no, the recovery, underlying recovery is very strong. So which one of the signals are right? And to me personally, I believe, uh, notwithstanding the second wave and the third wave and the fourth wave we might see, as long as the peaks are lower, I think the worst of the uncertainty, the worst of the impact of pandemic on the economy is behind us. The time we saw in the last year, same time in March, April, May, June, when there were so many unknowns. We didn't know where it will peak, where it will stop, where we will have vaccine in place. Today, as we speak, despite of cases going up, I would not worry as much because we know the solution today. We didn't have the solution last year this time. So that's one big positive. Second, the population at large, the businesses at large knows how to deal with rising cases, how to protect oneself, how to manage businesses, work from home. All those things were unknown at this point of time last year is not unknown today. So to me, I think the economic recovery will continue to get stronger. Albeit some of the sectors might have a little bit of setback because of the second wave and a second lockdown, if any. But nevertheless, I would believe the economic recovery and the earnings backdrop will continue to support the market despite of small hiccups here and there.
Okay, and then a word on how do you read this whole fear that the market has on the rising US yields? I mean, social media is agog with the comments. Some people say, "Oh, the Fed, the yields are proving the Fed reassurances to be irrelevant," and it usually is never like that, right? Because the central banks currently are probably the most powerful body there. How do you read the market fear on the rising yields?
So I think there are two reasons why market is fearing because a lot of this market recovery, I would say, the equity market recovery, the flows from US have been supported by significant liquidity that exists in the US market. So obviously, if the interest rates were to rise and to some extent Fed support, overall support, both in terms of liquidity and low interest rates, were to start unwinding, there is a rightfully we are afraid that this US flows or the FII flows which have been sort of supporting the market might not be there for longer. But if you look at fundamentals, what a rising yield or a rising inflation is telling you is that the efforts made by central banks and the governments globally in US, in Europe, Japan, India, everywhere is finally taking shape. We are seeing uh, signs of not only recovery in GDP, but the commodity prices is telling you the demand is rising. Uh, we are seeing various data points, be it consumption of fuels and others, uh, where year on year we are seeing growth, even non-pandemic to non-pandemic comparison. So that's the good news. Now, this the two counter things that would the earnings momentum will be strong enough on the back of economic recovery to counter the flows which might slow down. And to the extent you see some sort of corrections in the market, there would be always leveraged money into the markets, which sort of gets a jolt in such an environment where the liquidity driven market going up uh, sort of slows down, but the underlying fundamentals will give you support. So I would rather focus on underlying fundamentals, economic recovery, and not worry too much about short-term corrections in the market that would come through because liquidity might not be as supporting as it was through the last year.
Yeah, the narrative almost seemed to be that the improving economy might actually be negative for the markets, and that's such an antithesis, so to say, Anand. So you are saying that there might be temporary downdrafts, but largely an improving economic scenario will eventually be positive for equity markets too.
And particularly for equity markets, actually inflation is a such not such a bad problem. So rather than deflation, I would have inflation. It's a problem. A lot of inflation is also a problem, but nevertheless, it's a good problem to have rather than to have a deflation. So we were sitting last year same time where we were worried about deflation because it's very very painful for economy in general, businesses in general. Today we are afraid of inflation, and in the first round of inflation, frankly, equity markets will be supported rather than being impacted negatively. The existing inventory, the margins, everything will improve. Actually, earnings can get further supported by a higher inflation. So I'm again repeating, yes, it does take away. It does take away the large support which financial markets have seen from central bankers, and that was the right support we needed when we were dealing with deflation, we were dealing with economic slowdown. So I would not expect that this would not reverse. Maybe the US Central Bank is still saying it's in FY23 is when we are seeing the unwinding little bit starting. So uh, some sort of correction, but I'm not seeing significant drawdowns in the market because of this.
Net, you would reckon, Anand, that 12 months out, 18 months out, I'm not asking you to make a index level prediction, but would we as portfolios be higher than where we are right now if chosen wisely?
Indeed, given what we know today about the markets, given what we know about the economy, the earnings recovery which we are seeing, and I am again repeating, uh, I am not that concerned about the subsequent waves because what impacted the most. The first was the fear of unknown, how
Mm.
the countries, how the economies will deal with it, how the individuals will deal with it. Today, that's not the fear. If there were to be a rising cases, the government machinery, the municipal corporation, the individuals, the societies, everybody is prepared how to deal with it.
Yeah, I mean, certainly. I mean, on a personal level too, somebody getting COVID now is not viewed with such fear as it was earlier, for sure. Okay, Anand, the other question is uh, at the end of quarter 3 and say January, everybody was going gaga over the strength of earnings, and even if the top line growth was not quite there, the margin performance from India in both in quarter 2 and quarter 3 was quite exemplary. Quarter 4 and maybe ahead, we might have the problem of rising commodity prices, and corporate after corporate who talk to us have confirmed that as well. Is that a worry for India?
Indeed, I think not for India Inc. as a whole, but there would be specific businesses who won't have pricing power to pass it on to their customers, will have to worry about the commodity prices. But again, I would say a lot of this strong commodity prices is also because there are some sort of supply bottlenecks. And as the economies open up, as the supply chains stabilize, and that's what central banks US is also saying that this inflation, this rising commodity prices will be more transient. What we saw in last 2-3 days, a sharp correction in oil prices will again ease a lot of pressure. So uh, at this point of time, I would not say that these commodity prices uh, will upset the entire economic recovery. Uh, there would be businesses who would be able to pass on the price hike in the commodities to their customers. They would continue to thrive. There will be businesses who would not be able to do it. They will have some sort of margin pressure, but things will adjust. So at this point of time, not too worried about these rising commodity prices as we believe this is transient in nature. This is not here to stay forever.
Mm. Well, and maybe, I mean, there's this very interesting data point that we dug out, and this was, of course, data until yesterday, not counting Friday's move. But India, compared to the other screens, has actually lost quite a bit. Look at that. Nifty, Sensex, and then the Philippines index are the three which have lost significant, market value, so to say. The others, be it Hang Seng, Nikkei, Kospi, even the Dow, have all been up over the last 5-day period, and it's a too short a time frame. But just mentioning how India seems to be taken out for special punishment. And I think you reckon that in part that was due to the rising crude prices and rising COVID cases and crude having cooled off. That might just soothe some frayed nerves.
I think indeed rising crude prices will remain a pain point for India uh, in medium term as well, in short to medium term as well, and rising. But also you have to see in the backdrop that we had seen significant rally in the markets led by banks, financials, cyclicals. Uh, Post-budget, we had again a new round of optimism in the economy, given government is also going to support the recovery this this year onwards. I mean, this budget onwards, we are seeing significant fiscal deficit support, which is there for the economy. So, while I would say in the short term, India has maybe corrected a little more uh, vis-a-vis the other markets, given that we have a uh, crude dependence on imports significantly and also rising cases more recently. But I think again, I would not get too perturbed with the short-term movements.
Okay.
This thing is something the markets, particularly investors who are new to the markets, will have to get used to it. That markets are volatile in the short term. They are driven by liquidity in the short term, and not so much from the fundamentals. But the moment you increase your horizon, when you look from more than 6 months, 12 months, 24 months, and maybe further longer, fundamentals is what matters more than liquidity. Whereas in the short term, unfortunately, the liquidity, the US yields, the crude prices, the sentiments overpower the fundamentals. So when I look back into fundamentals, I think India is well poised. We still have a lot of firepower, as we've seen in this budget. Also, we have fiscal deficits which can support infrastructure, it can support growth. We have our long-term story of demographics, which will continue to support rising earning members per family. Consumption is something which is a large part of the economy compared to many other emerging markets. All this will continue to support in the long term, while it's a little bit of a short-term negative at this point in time.
Okay. So let's focus on that, Anand. We've done a top down. Now let's do a bottom up. How are you driving your teams towards the portfolios that you want to create in your PMS and in your AIFs in the current scenario? What are the underlying factors? Where is it that I mean, are you preferring growth over value, for example? What is it that you guys are doing out there at ICICI Pru?
I think, as I said, economies recovery and earnings will continue to support the market. In that situation, we would want to look at bottom-up ideas at this point of time. It will become much more important to be in the right segments of the market, because in the early stage of the recovery, we very well knew the sectors and the companies which are resilient to the COVID slowdown did very well. And obviously, they only pushed market significantly upbeat, IT sector bit, consumer, non-durables, which is telecom, and other sectors which were least impacted by COVID. I think where we stand today, our team is continuously focusing on businesses which have one, operating leverage, and also if it has a financial leverage, much better. When I'm saying operating leverage, is the businesses which have capacities but they're underutilized. So any recovery, any incremental top line growth rate, actually significant portion of that will flow to the bottom line. So we are looking at businesses where we can have, and which are typically our recovery plays, which has operating leverage, which has subsequently, if their cash flows are able to support you in reaping debt, that also flows to the market cap. So that's financial leverage we're talking about. As we speak today, the most leveraged businesses in any country are banks, which are levered between 8 to 16 times, depending on what capital adequacy they have. I think they will be the primary beneficiaries as economy goes back to normal. We had significant stress in those banks in the early stages of COVID. The resilience has been shown. The government support to the businesses has shown that there has not been significant slippage as was expected in the early stage of the pandemic outbreak. I think as the economy recovers, all the large provisions these businesses have made, they have become robust, they have become more strong, be it banks, be it NBFCs. I think they continue to look good. They have good operating leverage to benefit as the credit offtake also picks up.
Yeah, and I can clearly see some bit of that and some bit of contra at work in your portfolios, right? Because I think you guys were amongst the first ones to have fairly large positioning in pharma when nobody was looking at it. And if I'm not wrong, your current positioning is not as large as it used to be, and it's probably much lower than what some of the other street has too. So you're clearly rotating the caps and doing sectoral rotation too. Is this in line with the strategies that you employ in your PMS? I mean, because you might be doing some bit of contra investing, some bit of top down, bottom up toggling as well. And I was reading your presentation that you have something called as a core portfolio and a satellite portfolio on top, which kind of books profits and then strengthens the core. So, how is explain that strategy to us, Anand?
Yeah, I think in our FlexiCap strategy, we are very clearly focused that you have to look at two parts. One, you have a very strong underlying growth in the segments of the market which are structural in nature. On
And
the
which would those
backdrop
be?
of,
Sorry, I'm just trying
sorry,
to ask you. Request you to I'm just going to request you to marry your thesis with the components out there as well. If you can do that, it'll be really
sure,
helpful for our
sure,
viewers.
sure. So I think the big story in India is about the large population which is having rising per capita income. In a simple words, you are moving from a single earning member, four dependents, middle class family to more than one earning members, lesser dependents. This is typically what we measure as a dependency ratio in any country. In the past, the falling dependency ratio has helped many economies like China, Japan, much earlier, and more recently Southeast Asia. India will go through the same phase, and that uh, middle class and the upper middle class gives you a lot of opportunities, and that is the B2C businesses that we own today. As we speak, financial services in India is much lesser B2B and more B2C at this point of time. Retail banking, retail financial services, and those spaces we continue to like. Again, the same middle class is consuming more on transportation, consuming more on entertainment, more on travel and tourism. So this is the flow, which is more structural in nature, which forms almost 70% of the portfolio. As you rightly said, as we speak today, we have reduced our exposure to pharma because pharma was indeed underperformed significantly, and around the COVID times, it became much more in the limelight, but we had a very decent pharma exposure before that also. As we speak today, I think the stock prices and the valuations don't give that much comfort, so we have sort of reduced our pharma exposure. And as I'm telling you today, we are looking for operating leverage, financial leverage. There we are looking at financials continue to look good. There we are seeing, from a medium term to long term, good opportunities. Looking at metals in India, because again, metals are dependent on the global recovery. That is in good shape. And metal companies in India again have had a very difficult 5 to 6 years. It's the right time to be in that sector where we will benefit from a rising commodity prices or a stable commodity prices where there's enough money to be made and they all leveraged so that debt unwinding will also benefit in terms of a higher market cap.
Okay. Um, where is it that you believe you are contrarian currently? Because I'm presuming that some bit of your portfolio and the maturity and the duration of your investors coming into your schemes allows you to go contrarian in a much larger way than maybe other houses. So where is it that you are contrarian? And do you reckon that these bets that you're taking are taken with a slightly longer 2 3 year time horizon?
I think today the biggest contrarian play would be mid caps and small caps. I think we have seen sort of a carnage in that space, particularly starting from January 2018 and subsequent some change in regulations also led to subsequent sell-off in that sector. So 2018 was very difficult year for mid caps and small caps. 2019 was not that bad, but again, globally and locally, we have seen a lot of liquidity flowing into large businesses, very concentrated flow in that businesses. So 2019 was also equally not so great for mid cap, small caps versus large cap. Large cap you talked about. Obviously, 2020 we had COVID, and that led to a last nail. But to me, the small and medium enterprises which have survived demon, survived GST, survived NBFC crisis, and even the COVID, I think uh, gives me very clearly that they have very, very strong fundamentals, and that's how they have been able to survive. This small and mid caps at this point of time still offers huge value. Again, this is all selective. As I said, the bottom of stock picking is more important. So I'm not going by, you can go ahead and buy anything and everything. There would be winners and losers in each segment, each sector, each market caps. But if I were to go contrarian today, I see mid caps and small caps as a space where we can still find a lot more alpha, a lot more value, a lot more difference in the intrinsic value versus the current price which they are trading. Whereas large caps is fairly, you know, explored, fairly researched. We find much lesser opportunities. There also we have pockets like metals and others where we find a significant value. But in terms of the big contrarian call today is mid caps and small caps.
Okay.
Mid caps and small caps.
Last couple of questions, Anand. One of them is, I'm using a sectoral example out here to understand how you are thinking. But when I look at IT, for example, save for the couple of large companies like TCS, Infi, some of the other large caps are trading at significant discounts to mid caps. Now, my question to you is, maybe the growth visibility in some of those mid caps, because they might be more nimble, etc., is much more, and which is that the market in its wisdom has duly rewarded them. How would you approach this? Would you bet on, if you were betting on IT, and I'm just using IT as an example, I'm not asking you to give me an answer for IT, but I'm just asking you that if you are betting on IT, would you bet on the mid caps wherein the valuations are higher than some of the proven large caps, but the growth visibility or the growth run rate might be more? Or would you choose to bet on growth at reasonable price, even if that growth is slightly lower than the growth in some of the mid caps?
Sure. So I think you'll have to understand that mid caps and small caps over a long run deliver higher returns over the large caps only because uh, given the size, they can continue to grow much faster. Whereas the large companies, given their own size and they being a significant part of the industry, their ability to outperform significantly in terms of top line growth rate is not there. So this is a fundamental difference. Having said that, mid caps and small caps, by virtue of you are emerging business, you might not have best in class management, you might not have best in class balance sheet strength, and to that extent, the mortality rate in mid cap and small cap is also much higher than the large cap. So I think there are very two different segments. Large caps gives you reasonable growth. If you buy at a reasonable price, it's the right thing to do. Nothing wrong with that. Whereas mid cap and small caps depend more on economic recovery, and they have more mortality. With that backdrop, I think the stock picking becomes very important. Each mid cap within the same sector can have different variables. If I were to pick 4 different mid cap IT companies, they will actually grow very differently depending on which space they are focused on. Secondly, very important is that each mid cap you buy needs to have a certain strength, certain sustainable competitive advantage vis-a-vis the other players in the market, and that applies to any company in any sector. I'm just, because we are discussing IT, I'm saying that. But you need to have expertise, you need to have a strength which is better than the large guys. Otherwise, the large guys will just, take away your business. Same applies in cement, same applies in steel. So we continuously look for mid cap and small cap which have sustainable competitive advantage as a company and within the sector also, so that they can continue to outperform, continue to grow faster than the industry growth rate. And that is very important. So I don't think I have a straightforward answer for you whether mid cap is better or large cap is better. I think there is a merit in investing in both. But the homework required, the work required, the background study required in the mid cap is much higher because one, the information is also not readily available. Plus, as I said, they are not proven businesses, proven management. So you need to be carefully monitor that.
That's true. No, this was helpful. Anand, one final question, and that is this whole IPO mania. And what is your view there, considering that there are 2 aspects out here? One of the reasons being cited for the recent pain is that, oh, the primary markets have sucked out the liquidity from the secondary markets. And two, it's very easy to blemish the retail investor for getting getting caught up in a sucker's rally, so to say. But in almost all of these IPOs, which were expensive and are heavily oversubscribed, I've seen some very smart institutional money participate as well. So it's not just the average Joe on the street who might have been caught up in this. There are enough and more institutional participants out there too. What is your view out here?
I think to me personally, the IPO investing is actually more difficult than investing to secondary market. Given in the secondary market, we have companies which have track records, we have interacted with them in the past, know them very well. Whereas in IPO, it's tough. They're the first time coming to the market. Even for them, their ability to understand the investors and guide them properly is something which is unproven. So while the evaluation is same, we similarly evaluate both secondary market opportunities and IPO market opportunities, be it in terms of business, management, and valuation. But more often than not, especially in the mid cap and small cap IPO, management is not that proven at this point of time. Whereas in the secondary market, we have a luxury of having tracked them for 5 to 10 years. Some of them are 15 years. So at this point of time, we continue to evaluate IPOs on their merit, but we take a lot of these opportunities with pinch of salt and would be very, very careful. So that we have seen the past, every time the markets have been in euphoric, we have seen valuations in the IPO market, and that is my worry even today, that valuations are not that attractive vis-a-vis secondary market. At times it is at a premium to the secondary market. And to that extent, whenever the liquidity gets sucked out, markets get corrected. We have seen sharp erosion of that in IPOs in the past as well.
Yeah, I mean, 80 times for a chemical company was just astounding for me. But anyways, Anand, this was lovely talking to you to get some sense of how you're thinking about this whole market and steering your team towards investing in your schemes. Thank you for taking the time out and speaking to us today.
Thank you, Neeraj. Thanks. My pleasure to be here.
It was our pleasure to have you, and stay safe.
Same to you. Thanks.
Thank you. And viewers, thanks for tuning in to this edition of The Talking Point.